morning, friends. I'm Dr. Baladevi, Assistant Professor. So, students, in today's class, we are going to discuss about an overview of financial market, legal and regulatory framework. First, let us concentrate on reforms in the financial sector. Then, we will discuss about the need for financial sector reform. Right? As far as the financial sector is concerned, the financial sector reforms are the steps taken to change the banking system, capital market, government debt market, foreign exchange market, etc. An efficient financial sector enables the mobilization of household savings and ensures their proper utilization in productive sectors. The financial sector constitutes the commercial banks, non-banking financial companies, investment funds, money market, insurance, as well as pension companies, real estate, etc. It forms the core of an Indian economy which facilitates the mobilization and institution of financial resources. It is engaged in providing financial services to the customers of the commercial and retail segments. As the economy grows and becomes more sophisticated, the banking sector has to develop in a manner that is supports and stimulates such growth. With increasing global integration, the Indian banking system and the financial system as a whole had to be strengthened so as to be able to compete. India has had more than a decade of financial sector reform, during which there has been substantial transformation and liberalization of the whole financial system. Therefore, it is an appropriate time to take stock and assess the efficacy of our approach. It is useful to evaluate how the financial system has performed in an objective quantitative manner. This is very important because India's path of reforms has been different from most other emerging market economies. It has been a measured, gradual, cautious, and steady process divided of many flourishes that could be observed in other countries. Until the beginning of 1990s, the state of the financial sector in India could be described as a classic example of financial depression. The sector was characterized inter alia by administered interest rate, large free emission of resources by the authorities, and extensive micro regulations directing the major portion of the flow of funds to and from financial intermediaries. While the true health of financial intermediaries, most of them public sector entities, was masked by relatively effective accounting norms and limited disclosure. There were general concerns about their viability. Insurance companies, both life and non-life, were all publicly owned and offered very little product choice. In the securities market, new equity issues were governed by the plethora of complex regulations and extensive restrictions. There was very little transparency and depth in the secondary market trading of such securities. Interest rates on government securities, the predominant segment of fixed income securities, were decided through administered plans. The market for such securities was a captive one where the players were mainly financial intermediaries who had to invest in government securities to fulfill high statutory reserve equipments. There was little depth in the foreign exchange market as most such transactions were governed by inflexible and how limits and also prior approval requirements. Compartmentalization of activities of different types of financial intermediaries eliminated the scope for competition among existing financial intermediaries. In addition, strong entry barriers competitions from new entrants. The end result was low levels of competition, efficiency, and productivity in the financial sector. On the other hand, so credit constraints for the productive entities, on the other hand, especially for those in the private sector. The major drawback of this regime was the scant attention that was placed on the financial health of the intermediaries. Their capitalization levels are low. The lack of commercial considerations in credit planning and weak recovery culture resulted in large accumulation of non-performing loans. This had no impact on the confidence of depositors. However, because of government ownership of banks and financial intermediaries. The predominance of government securities in the fixed income securities market of India mainly reflects the captive nature of this market, as most financial intermediaries need to invest a sizable portion of funds mobilized by them in such securities. While such norms were originally devised as a prudential measure during certain periods, such statutory norms preempted increasing proportions of financial resources from intermediaries to finance high government borrowings. The interest rate on government debt was administered and the rate of interest charged by the Reserve Bank of India for financing government deficit was concessional. On top of this, there were limited external capital flows. Such a closed economy setup kept debt markets underdeveloped and devoid of any competitive forces. In addition, there was hardly any secondary market for government securities, as such transactions were highly and operated through over the telephone deals. The provision of fiscal accommodation through ad hoc treasury bills led to high levels of monetarization of fiscal deficit during the major part of 1980s. The phase of nationalization and the social control of financial intermediaries, however, was not without considerable positive implications as well. The sharp increase in rural branches of banks increased deposit and savings growth considerably. There was a marked rise in credit flow towards economically important but neglected activities, most notably agriculture and small scale industries. The urban bias and more preferences of banks to lend the industrial sector, especially large industries houses, was contained. The implicit guarantee from public ownership created an impression of infallibility of those institutions and the expectations for self-fulfilling. There was no major episode of failure of financial intermediaries in this period. Then let us concentrate on the reforms in the financial sector. The initiation of financial reform in the country during the early 1990s was to a large extent conditioned by the analysis and recommendations of various committees, working groups set up to address specific issues. The process has been marked by gradualism, with measures being undertaken after extensive consultations with the experts and market participants. From the beginning of financial reforms, India had resolved to attain standards of international best practices, but to fine-tune the process, keeping in view the underlying institutional and operational considerations. Reform measures introduced across the sector as well as within each sector were planned in such a way so as to reinforce each other. Attempts were made to simultaneously strengthen the institutional framework while enhancing the scope for commercial decision making and market forces in an increasing competitive framework. At the same time, the process did not lose sight of the social responsibilities of the financial sector. However, for fulfilling such objectives, rather than using administrative fiat, attempts were made to provide operational flexibility and incentives so that the desired ends are attended through broad interplay of market forces. So the main aim of this reform in the earlier phase of reform, known as the first generation reform, it was to create an efficient, productive, and profitable financial service industry operating within the environment of operating flexibility and functional autonomy. While these reforms were being implemented, the world economy also witnessed significant changes coinciding with the movement towards global integration of financial services. The focus of the second phase of financial sector reform, starting from the second half of 1990s, therefore, has been the strengthening of the financial system and introduction of structural improvements. Two brief points need to be mentioned here. First, the financial reforms in the early 1990s were preceded by measures aimed at lessening the extent of financial depression. However, unlike in the later period, the earlier efforts were not part of a well thought out and comprehensive agenda for extensive reforms. And the second thing is financial sector reform in India was an important component of the comprehensive economic reform process initiated in the early 1990s. Whereas economic reforms in India were also initiated the following an external sector crisis. So, unlike many other emerging market economies, where economic reforms were driven by crisis followed by a boom bust pattern by policy liberalization in India. Reforms followed a consistent driven pattern of sequenced liberalization across the sector. So that's why, despite several changes in government, there has not been any reversal of direction in the financial sector reform process over the last 15 years. So, as pointed out by Governor Reddy during 2022, 2002, the approach towards financial sector reforms in India is based on Panchatra or five principles. What are the five principles here? One is cautious and appropriate sequencing of reform measures. Second one is introduction of norms that are mutually reinforcing. Third one is introduction of complementary reforms across the sectors. Fourth one, development of financial institutions. And the fifth one is development and financial trends. So an important feature of the move towards globalization of Indian financial system has been the intent of the authorities to move towards best practices. So this is illustrated by the appointment of several advisory groups. It is designed a benchmark Indian practices with the international standards in several crucial areas of importance like monetary policy, banking supervision, data dissemination, corporate governance, and the like. So towards this end, a standing committee on the international financial standards and codes was constituted, and recommendations contained wherein have either been passed or implemented or in the process of the implementation. Then there are some different reforms in the banking sector, and these are the important aspects in the today's class. Thank you, friends.